What does that mean here? I mean, there's been quite the rise, upwards of 20% in the last few days, so we're kind of entering bull market territory again. So do you expect that trend to continue, or is it going to perhaps drop again on the back of that news?
No, it'll drop. And the reason I say that, it might be towards bull market. It's actually more referred to as a bull run. And what I mean by that is that during bear markets, the most stereotypical part of a bear market is increased and pretty much extreme volatility, which is what we have. And volatility doesn't distinguish between directions. It doesn't matter if it's going up or down. When you're seeing percentage point movements per day, that is extreme. That is not normal market trading per day, and that's what we're getting. So, yes, it's almost rallied 20%, but that is a typical bear market movement. We saw it several times during the GFC. In fact, in October 2008, we saw that do that 3 times over that period of a 20% rally in terms of what happened. So I do expect to fall. I do expect to see probably at least another decent leg down before we get to the bottom of this. And unfortunately, that means a little bit more investor pain.
Evan, how much does that have to do with, your ordinary punters who are seeing an opportunity here in the ASX, the local share market, to make some coin because so much value has been wiped off, some pretty good blue chip stocks? So how much of that rise has to do with people rushing in and not kind of factoring in the drops that are inevitably going to come?
A bit of all, Peter. And look, the way I look at it also is that you've also got the end of the quarter that happened as well. There's a few other things that sort of fed into possibly why you saw the rise over the last couple of weeks. As I said, also, you can't deny that the fiscal stimulus that's coming in from both our government here in Australia and then around the world is certainly going to stabilise to some extent, or cushion probably is a better word, the economy over the next sort of 6 to 12 months. But in saying that, you're also having a scenario where, the bigger end of town, those that control industry super funds, those that are in pension fund runners, those institutional managers of money, they are also having to evaluate this, and they too would be positioning themselves in a certain way, and therefore they are the controller of larger sums of money, and they therefore are the ones that probably actually move the market much, much bigger than unfortunately than you and I can. They're also evaluating earnings in the next, the rest of FY20 and what FY21, whatever that's going to look like, is also needing to be put into it. And we get retail, spending on Friday. We get a few other data pieces from February, which are probably a bit a misnomer, considering that we don't know what happens in March yet. March is when this all really took off. That's what we're waiting for. So they're reevaluating what the rest of this year looks like, what the second quarter looks like, what the third quarter looks like, and what maybe the start of 2020 looks like. And at the moment, it's clearly under a lot of pressure, and that's a very, very understandable effect.